So the first question we have is, if we're not eligible to claim the tuition credits, what happens to them? Do they sit there forever? And to provide a bit of context, this individual says that their fees are paid by a third-party organization and cannot claim nor transfer their earned credits.
Yeah, that's interesting. So regardless of who pays the tuition, to the extent that you're paying tuition and you get a T2202A, so that's the form basically documenting that you've paid tuition, you can claim that tuition on your tax return. And to the extent that you don't need all those credits to reduce your taxes payable, those credits should carry forward. So certainly in cases where students might not even be taxable, they say, well, what's the point of me filing a tax return? I think by filing, the really important takeaway here is that if you claim the tuition, even if you don't use it, that tuition then carries forward for the future. And so even if it's many years down the road, like in 10 years before you start earning a high salary, very generally, most people are going to be able to use their tuition credits at some point in their career. So carrying them forward does have some value for sure.
Next question asks, can we claim interest on student line of credit or just interest paid on government student loans?
That's a great question. So if you've got just a regular line of credit, so you go to your bank and you take out a loan, and there's no special nature to that loan, unfortunately that interest, even though it was used to fund your education, unfortunately that interest wouldn't qualify as a claimable amount. The student interest generally has to be through a government program. So here in Ontario, we've got this concept of OSAP, and eventually when you get through university, you start paying that back with interest. And that would be an example of an appropriate mechanism whereby the interest would be claimable.
Can you describe to someone, or rather how someone would be taxed and how they would go about filing tax if they became a US permanent resident or citizen? For example, if they had dual citizenship and moved to the US for practice.
Yeah, so I would say two things in relation to that question. I assume that in the question, the person is currently resident in Canada, and the idea is that they're going to move to the US and start living and working in the US permanently. To that extent, what happens from a Canadian perspective is, as I mentioned, you're taxable as a Canadian resident on your worldwide income while you're resident in Canada. When you leave for another country, on the day that you cease to be resident of Canada, Canada's ability to tax that worldwide income stops on that date. In some cases, it's very clear what the date of emigration is. So if you left on March 7th to the US and you never came back to Canada, well, pretty clearly March 7th would be your emigration date. Some cases aren't as clear, right? So you might go to the US on March 7th, but you come back to Canada a month later to do some things and then go back. So the question becomes, well, what date do you pick as being your emigration date? And that date becomes very relevant for determining your taxation. So let's just assume that March 7th was the day. You would file a Canadian tax return to report your worldwide income from January 1st through to March 7th. From March 8th onwards, and I'm not a US tax specialist, but I do enough cross-border stuff to kind of know that from March 8th onwards, you would file a US resident return, and you'd have to report your worldwide income on the US side from that date forward. Now, the added wrinkle that was thrown into this question is that the person was a dual citizen. Americans, the US is one of two countries in the world that taxes not just on residency, but also on citizenship. So I think it's kind of beyond the scope of this presentation. I'd be happy to chat with whoever posed that question offline, but because you're a US citizen, it's particularly complicated because you're going to have to file a US return to report income for that January to March 7th period, even though you weren't resident in the US, but because you were a US citizen. So that type of return that you're describing is particularly complicated.
Great. Is income splitting likely to come back like it was in the past? So is it going to come back in the future, or is it gone for good?
Very, very good question. I think I think it's likely gone for good, although in the absence of a crystal ball, there's no way to be sure. What I can tell you is that every government that gets into power usually brings in different rules. Not to get too political, but certain parties tend to scale back some of the benefits that are available. Others don't. So depending on what party's in power and what's going on with the economy at that time, it could happen. Practically looking at it now, though, like just looking at our deficit last year because of COVID, I think the government, in all likelihood, unfortunately, is going to be going the other way and looking at things they can claw back further as a way to generate more tax revenue to fund what is a fairly significant deficit now. So,
what are the overall costs of incorporating?
So the costs of incorporation are going to vary by lawyer. So depending on who you use, obviously there's different levels of lawyers and they charge different fees. It's going to also vary by province depending on where you are. So, not to generalize too much, but a lawyer in Toronto likely would charge more than a lawyer in Halifax might, just as an example. I would say here in Ottawa, the average we see for incorporation on the legal side is generally somewhere between $2,000 and $2,500. So that's kind of an initial setup cost going kind of upfront. The bigger ongoing cost is going to be on the accounting side, in all honesty, because you're going to have to file a corporate tax return. As I mentioned, you probably want to do financial statements. To the extent you're taking out remuneration, so either a salary or a dividend, you're going to need either a T4 slip or a T5 slip from your company, etc. So there's going to be an ongoing cost of maintaining the corporation from the accounting side of things that, generally, just speaking for our firm, I think this is probably typical for a lot of firms out there. It's generally about $2,500 a year for the ongoing accounting fees. So the initial setup is one thing, but then you always have to keep in mind what's the ongoing cost of maintaining it.
Once we're making an income as a resident, should we be maxing out our RRSP contributions each year at the expense of paying off any outstanding debt, as the interest rate is low and is tax deductible?
Yeah, so these are great questions, guys. Really well thought out questions for sure. As a resident, so I talked about how your percentage as a credit is fixed, right? So it's 15% federal, and then whatever your provincial credit is, it's fixed. With a deduction, the benefit that you get from a deduction is tied to what is your marginal tax rate. And so the one caution I'd have for you, the only problem with using your RRSP room while you're a resident is, let's say your income, and I don't know what a resident would typically make these days, but let's just throw out a number and say you're making 60 grand a year. Well, your marginal tax rate total at that level is probably going to be roughly 30%. So what that means is that if you contribute $1 to your RRSP, you're going to save 30 cents in tax. Now compare that to a situation like I was talking about Jane in the case study. If her income is $300,000 and she makes a $1 RRSP contribution, well, because her marginal tax rate is 54%, for each dollar she puts in the RRSP, she's going to save 54 cents in tax. So you're quite right that if you've got other costs that you're trying to pay down, maybe you're trying to buy a house, you're trying to pay off debt or whatever it is, accumulating some of the money you're making for those other purposes and letting that RRSP room accrue and saving it for a time when your marginal tax rate is going to be higher might be the best course of action. It really depends on your circumstance, but generally it might be best to save that RRSP room for the future. The only other thing I'd add is that the RRSP room will accumulate. So it's not as if you don't use it in a given year, it's gone. It'll accumulate over time and you can always use it down the road.
It sounds like there are a number of tax benefits to being married. Are there any tax benefits available to someone who is never married or divorced? And this is specifically with regards to dividends to a spouse after you would turn 65.
Yeah, so taxes are always one consideration. Certainly, in terms of whether it's beneficial to get married or not, the one thing I would say, I talked about the basic personal credit. To the extent that you're married or you have a common law partner, and that spouse has limited income, you can effectively double up on that basic personal tax credit. So in other words, you can use your spouse's credit on your return. So that's one advantage. Probably the biggest thing you'll find right now in terms of a quote unquote advantage of being married is this whole 65 or older exception. It's not going to help you so much while you're working unless the rules were to change. But if you stockpile money inside your corporation, you turn 65, the whole idea is that rather than you take dividends and pay a high rate of tax, like let's say $200,000 of dividends and you're paying a higher marginal tax rate. Well, if you've got a spouse with limited income, maybe you pay them 100,000 and you pay 100,000 yourself. And simply by splitting the income amongst the two of you and taking advantage of graduated rates between the two of you, you're going to be much further ahead. So I think that's probably the biggest advantage of having a spouse is in retirement, being able to split that income.
Okay, great. So one of our viewers is saying that they were confused about the language around income splitting. I think you mentioned family members being passive employees. What does that mean to be a passive employee?
Yeah, so when the rules first came out, so the government said, yeah, we don't like these rules. We're going to tax the recipient of a dividend at the very highest rate to the extent that they're not actively involved on a continuous basis in the company. Well, you can imagine there's a lot of tax practitioners and small business owners up in arms because, and I remember writing to finance personally about this and saying, this, you guys are all wet. Like, how are we supposed to, as tax advisors, determine whether or not a family member has worked actively and continuously in the business? Like, what does that even mean? And so what the government has come out with is they've said, well, we're going to give a bright line test, meaning to provide clarity. If the family member works on average 20 hours or more per week in the business, this test will be met, and therefore you're free and clear. You'll have absolute clarity that you can pay dividends to your heart's content and not be subject to the highest rate of tax. To the extent somebody doesn't work 20 hours or more per week, well, then basically finance has said it becomes relevant what the facts and circumstances were. So depending on the nature of the business, maybe it's not a business that requires 20 hours of work per week, as an example. Then potentially you could still get out under this exception, albeit there's no clarity like there is with the 20-hour per week test. So what I always tell people as an advisor is, if you've got the type of business where you can substantiate that your family member is working 20 hours or more per week, perfect. You can rely on this exception. If you don't, I think it's fraught with risk if CRA came along and asked for support. In terms of how to support how much a family member is working, having them kind of compile a list of duties that they're doing in your business and specifically recording their time would be a good idea. So, 4 hours on Tuesday, 5 hours on Thursday, etc. Because the last thing you want to do is get 3 years down the road and CRA comes and audits and says, okay, well, tell us why you think this person was actively involved in the business. You don't want to be in a position where you're scrambling to try and come up with all this support. Whereas if you do it as you go, it's going to be much cleaner.
This next question seems very relevant to all of us. Interest paid on student loans is deductible and only begins accruing upon graduation. My original plan was to transfer this outstanding student loan to my line of credit upon graduation, which offers a lower interest rate than provincial student loans. Is there a potential savings to paying the higher interest of a student loan, since this is income deductible, whereas the line of credit interest is not?
Yeah, excellent question. And the short answer here, unfortunately, is that it's going to depend. And so I think what you'll have to remember is that you get a credit for the interest that you're paying. And that credit, depending on what province you're in, is going to be roughly 20%. In some provinces, perhaps a little bit higher. And you've got to compare that to the fact that your interest wouldn't be deductible or claimable if it was just kind of quote unquote regular interest. And so depending how much that income tax or the interest difference is, so in other words, if you're paying 5% on the official program and maybe you're getting 3.5% on the line of credit, you would have to work the math and work backwards and say, well, is the paying the 5% and getting the tax advantage, is that the same or better than just putting them on my line of credit? And depending on what that math looks like, it could go either way, I guess, depending on what province you're in.